Hello, everyone. We're going to go ahead and get started. I'm Heather Rodemaker-Taylor with First Nations Oista. I'm excited to welcome you to our discussion of the Indian Loan Guarantee Program, ramping up your CDFI's lending to Native entrepreneurs and tribally owned businesses, with Joanna Donahoe joining us to present. As we mentioned in our webinar description, Joanna is going to discuss how CDFIs can qualify for this program, what types of business customers this could help you serve, and examples of success stories. You're also going to hear about what's great and what's not so great about using federal loan guarantees. Our hope is that participants will leave this webinar with more information about additional potential funding sources, and we thought that this topic would be helpful to anyone thinking about or working on accessing additional capital, which is really the majority or all of you. So this webinar is the 13th webinar in a monthly series as part of the Native CDFI Capital Access Initiative some of you are participating in, which is funded by the Northwest Area Foundation. And I say this for all of these webinars, but what's great about this webinar series is that all the topics discussed focus on different ways to grow your capacity to access capital, which is a challenge we all face. So now to get us prepared, I'm going to let Stephanie highlight some of the GoToWebinar features for you.
Good afternoon. Thank you so much for joining us. So the first thing I'd like everyone to do is to locate the question and answer feature on the GoToWebinar platform. And please answer the question, what organization are you representing today? And I'll just give everyone a few moments to locate that feature and answer the question. And throughout the presentation, if you have any questions, please feel free to type in the question as we're going along, and Joanna will answer the question as they come up. Or you can hold your question until the question and answer section of the presentation. Also, please feel free to raise your hand if you would like us to unmute you, and you can ask your question directly. Great, I see we have representation from Wisconsin, Alaska, down in New Mexico. Thank you all for joining us.
Perfect. Thanks, Stephanie. So yeah, like Stephanie said, feel free to use that box the whole time, and we'll make sure to interrupt the presenter and let her know your questions. Same thing if you raise your hand and you want to verbally ask the question. Or like Steph said, you can always wait till the end and we'll have a Q&A session too. So that being said, I'd like to turn the webinar over to Joanna Donahoe. She's a partner with Seven Sisters Community Development Group, a national community development consulting firm. She has over 25 years of experience working with nonprofits, housing authorities, and CDFIs serving low-income and Native communities. And she specializes in organizational development, coalition building, advocacy, homeownership strategies, capitalization and fundraising, private sector partnership building, and strategic planning. She began her career working on public policy issues in Washington, D.C., where she was an attorney at the U.S. Department of Treasury and a legislative representative for National Banking Trade Association. She also worked as a program director for First Nations Oista and a fellow for the U.S. Department of Housing and Urban Development Southwest Office of Native American Programs in New Mexico. So all that being said, which is wonderful, it's my pleasure to introduce Joanna Donahoe. All right, Joanna, I'm going to let you take it away. Oop, and I think I muted her. So now you're good, Joanna.
Okay, great. Thank you so much, Heather and Stephanie, and good afternoon to everyone on the line. And thank you for joining us today. Very excited to be with you to talk about this topic. Thanks, Heather, for that introduction. Although most people don't read the whole thing. It's kind of embarrassing to listen to it. But I know many of you on the line have worked with you guys on some of the CDFI fund training and technical assistance initiatives. So happy to see everyone's name and look forward to a little discussion throughout this webinar. So let's go ahead and just jump right into it. As we get started, I wanted to kick off our session with a little bit of a poll to see who's on the line with us. So Heather's putting up the poll now, and if you wouldn't mind just going ahead and answer with regard to the Department of Interior's guaranteed or insured loan program, let me know if you are an approved lender, if you are an approved lender but haven't really kind of gotten into the program yet, if you want to become an approved lender, or finally the fourth choice is you don't know anything about the program and that's why you're on this webinar to learn about it, to decide whether or not it's right for you. So if you wouldn't mind, just go ahead and click on whichever choice fits your description. And
We're
then
at
I'll
80%.
Okay.
And 87% have voted. We'll give them just a couple more moments. So we've almost got all the votes in.
Perfect.
It looks like that's
this is getting you guys, you ready?
Yep, we just closed the poll. So we had 38% said, I want to become an approved lender, and 62% said, I don't know anything about the program.
Great. Okay, super. So there's nobody on the line right now that's already in the program. Okay. So that I just wanted to do not only to find out who is on the line, but also to get us ready for voting for next week. We're all going to be happy to have the election behind us, I'm sure. Okay, so then let's see if we can educate the 60% of the folks that want to learn about this. So this program has a very complicated name, Indian Affairs Loan Guarantee Insurance and Interest Subsidy Program. So let's see if we can break it down. So this program has been around since 1974. It was part of the Indian Financing Act of 1974. And you may know it as I even have called it until I found out that the name was wrong. I always called it the BIA Guaranteed Program. But it's actually not under the BIA anymore. As you guys probably know, Interior has kind of added new departments and restructured. And so now this is under Interior, not BIA, although the regs do still say BIA. But it's been around since '74, but it's been through several iterations. In the 2000s, they brought back the insurance program, so we're going to talk about that. But when it was created, and even today, the program is intended to help borrowers to obtain financing. So it's kind of like a gateway for some borrowers, and we'll talk about who those borrowers can be, to get into the financing realm. It may be, like many of your borrowers, that they work with you first, and they kind of get into the lending arena, and then they may go eventually qualify for mainstream lenders for conventional lending. So this program helps to facilitate that progression as well. It's governed by regulations, 25 CFR Part 103, and I've included in the resources a copy of the regs, and since its beginning, it's financed nearly $1.4 billion. So it's a pretty successful program, and I think that it's limited mainly by the funding that's available from Congress. But I know I've heard some people say it's underutilized, and I've heard others say, that it's really limited by appropriations. But let's talk more about what exactly it is, and you guys can decide whether or not it makes sense for your clients, and whether or not we can help to increase the loan volume and add on to that $1.4 billion from 1974. So generally speaking, there are three types of borrowers. Tribes themselves can borrow under this loan program. Individual members of federally recognized tribes can be borrowers, so Native people. And entities that are at least 51% owned by members of a federally recognized tribe can also be borrowers. So essentially what that means is tribes, tribal enterprises, Native-owned companies that are owned by 51% Native, or an individually owned Native company. So I'm sure that many of your clients fit into one of these categories. Some of you may lend to tribes themselves or their tribal enterprises, and of course individual Indian people and Indian companies, Indian businesses. So it's a pretty wide range of eligible borrowers. And as far as the other borrower requirements, I mentioned already that they have to be 51% Native owned. And that's important because it's targeted, it's a program that targets Indian people, Alaska Native and American Indian people. So that ownership requirement must be maintained throughout the term of the loan. And that sometimes can come into play if there's an equity interest that's sold, and you just have to make sure that your borrowers maintain that Native ownership. And the other requirement for lenders, for borrowers, that I really wanted to stress is that it has to benefit the economy of a reservation or the tribal service area. And that's kind of a broad statement, and you'll see, we'll talk a little bit more about that down the road, but it's definitely looking at economic development with a connection to a reservation or tribal service area. And the next requirement is that at least there must be 20% tangible equity in the project being financed. So the borrower has to have equity in the program, so they can't kind of be a proxy if they're a Native person and on behalf of another company. They actually have to have at least 20% equity in the company. And this program can't be for relending, so a borrower can't borrow from you and then relend to someone else. It has to be, the beneficiary has to be one of those eligible borrowers. And while some programs that you may be familiar with have require that the borrower has been declined by other people, that's not the case here. The borrower doesn't have to go and apply to other programs and be turned down and have a documentation of a decline letter or anything like that. But the lender does have to say and kind of document why the guarantee is important to making the loan. And I'm going to say this now, and I'll say this throughout the discussion, is that this doesn't mean that lenders, CDFIs, banks, whoever the lender is, can make bad loans through this program because it's guaranteed. It just means that the guarantee provides that extra level of comfort in a loan that might be a little bit riskier or might be some question as to some component of the loan. So it's important for the lender to say, if not for this guarantee, I wouldn't make this loan without the guarantee because of X, because there was an issue with the collateral, or we were concerned about something in the credit history, or some concern about the future of the business. So that's definitely something to be mindful of. And then, of course, other components, requirements for the loan is that there can't be excessive interest rates or fees, and that's part of the Bureau's requirements for their loan program. So that's a quick overview of the requirements. Let's get into kind of who the lenders are. Whoops, I did it one too many times. Let me go back. I'm not seeing. Okay. I think I'm going the wrong way. Hold on, let me get my arrows sorted out here. Okay, so banks certainly are eligible lenders under this program. And in fact, the majority of the volume, according to the Department of Interior, is from banks. And I just included some examples of the types of banks that have participated in this program. The Native American Bank has been very active in expanding, and interestingly, a former staff person from the Department of Interior that worked in the division that manages this loan product, she now works at the Native American Bank. So it makes sense that she's very familiar with the program and has seen the benefits of it, and the Native American Bank has become more actively engaged in using the guarantee and the subsidy. Some are Native owned, others are not. All have Native clientele in their market. So this is just a few examples of the banks that are participating. So CDFIs are also eligible participants, which is why we're having this call. Native Community Access has become very involved in this, and I know they just recently changed their name. So for those that don't know, that's Dave Castillo's group down in Arizona, and they're now regional. Their name is Native Community Access. Lakota Funds and Forbands in South Dakota, and Citizen Potawatomi, CDC, are just a few examples of the Native CDFIs who are active in this area to varying levels. And I wanted to let you know who they were so that I'm sure you've got contact with some of these organizations, and you can speak directly with them about their experience and what the program, what doors the program has opened up for them. So the interesting thing is that there is no published guidance for CDFIs becoming eligible borrowers. They're in the process now, the Department of Interior is in the process now of updating the regulations. And they expect to publish them for comment next year after the election once things kind of work their way through the transition. And so I asked when I spoke with the Department of Interior, can you send me the regs that you follow for native CDFIs, the steps that native CDFIs have to go through to become an eligible borrower or to become a guaranteed lender? And they said, well, just tell them to call us. We'll work through that checklist with them. So they are in the process of transitioning to the new regs. You should still follow the current regs, but I added the little caveat on this slide that you should work with the staff because some of the current regs may have changed, which makes it tricky. But you definitely want to work closely with the staff to know what are the specific steps that you need to take to become a guaranteed lender, to actually get that, to be able to enter into agreement with them. So I think that, which is not to say you shouldn't read the regs. They're very easy to read. They're not that long, and it's good background and a good overview. As far as what the regs say now and what covers bank lenders, and there's a long list of ineligible lenders in the regs as well as non-bank lenders who are eligible. But as far as what banks must do, you have to be regularly engaged in the business of making loans. So if you're a lender of any type, unless you're a predatory lender or a lender who's not regulated by the federal bank regulators, you should be fine as a bank. Credit unions aren't eligible unless you're a CDFI. If you're a CDFI, then the credit union can participate. The lending entity has to be capable of evaluating and servicing loans in accordance with reasonable and prudent industry standards. So the Interior wants to make sure that the lenders are operating as the industry does, but they have these extra features in here to help the potential borrowers to be able to access capital. And there's another interesting requirement here that says you otherwise reasonably accepted to Interior, which seems like you could, that seems very subjective. And I asked about that. I said, well, what does this mean? And they said, well, basically we do an online search, a Google search to find out about the entity, to make sure that they are acceptable, to make sure there isn't a history or that they appear to be, a strong institution that is appropriate for engaging in this line of business. So it doesn't appear that that's too hard of a lift to meet that criteria. Now, with regard to
Joanna?
Yep.
I'm sorry to interrupt, but we have a question that just came through.
Okay, great.
Were native CDFIs eligible for this a year ago?
Yes, yes. I'm not sure when well, it's been a while. Let's see. I think it has to have been at least 10 years.
Hi, Joanna. We just lost your audio. If you could just call back in real quick. All right, folks, we'll give Joanna just a few moments to dial in. It does take a little bit of time, as most of you may have experienced, to dial into the webinar platform. But hopefully we'll be back up and running in no time. So just hang a few more moments in there.
Okay, folks, just a couple more moments. I think her call must have dropped, so we're just messaging her to let her dial right back in. We appreciate your patience, so just a couple more seconds.
Hello?
Oh, we
Hello?
can hear you now.
Stephanie?
We can.
Okay.
Yep.
I'm not sure what happened. I apologize for that, but let me just jump right back into that discussion. Sorry about that. My phone just went dead. Okay, so where we left off was someone asked if this was new, and I said no. CDFIs have been eligible for a while, and I think part of the issue is that the Interior hasn't done a lot of outreach. And it hasn't been until like OESA started doing these types of events where more people are starting to look at it and to consider it an option. So hopefully that answers the question that was asked. Okay, and I think, Stephanie, you took back my, there we go. Okay, so when I specifically sought more information about what exactly CDFIs have to do to be eligible, I was told that they must be operating for 3 years and that you have to have some type of federal or state source of funding, and that funding makes you subject to audit by a federal or state authority. So essentially that any certified CDFI that's been certified for 3 years would be eligible to participate. So I even went so far as to explore whether or not the certification requirement needed to be for 3 years, and they seem to say yes. But if you're kind of on the border and it's been less than 3 years since you've been certified, you may be able to make the case. And what I'm hearing from other CDFIs is that as long as you can build a case that shows that you're within the goals of this program, that many times you can make the case. And work really closely with the staff to make it happen. So those are the CDFI requirements. And again, I would stress that even because the current regs don't address this specifically, if this is something you want to pursue, your first step would be to start with the staff, talk to them, and get the specific checklist from them. And you might not be surprised to know that sometimes there may be inconsistencies depending on which region you're in. As with many federal agencies, it depends on kind of who you're working with. There are only 4 divisions, and I'll show you a slide that shows where the breakdowns are. And so you'll definitely want to talk to the person in your region. Okay, so what are the components? I mentioned at the beginning that this program is a very complicated name, and that's because it's got these three components. So essentially, if you're working with borrowers who are typically looking for over $250,000 for a business loan, that would require a loan guarantee. You would need to be a loan guaranteed lender. If you're lending under $250,000, then it's the loan insurance component, and you can do both. And then the third component is an interest subsidy, and that's for borrowers whose projected earnings are less than the industry norm. So if you know this is a startup business, and perhaps they're working in an area that is a remote area, and it's not clear how long it's going to take for them to kind of get up to speed and get to scale, you may explore whether or not it might make sense to apply for an interest subsidy for that borrower through this program. So most of the CDFIs that I've been in contact with participate in the loan insurance component of this because they're lending under $250,000. So how does it work? Well, first of all, the first step is for you to enter into an agreement, the CDFI, to enter into an agreement with the Department of Interior. And as I said, you need to get with the staff to work your way through those steps in the application process. I'm told that it's really not that complicated. It's a lot of paperwork. They ask you for what they need, you provide it, and then you move on. And you enter into an agreement that specifies, how the program works, and just like any other type of agreement with a guarantor. Then you underwrite your loan. You identify clients who fit into this program, and you underwrite your loan in accordance with the program requirements. There's a difference here, and there are a few differences along the way between the guarantee certificate, if you're operating with a guarantee, or if you would like to get a guarantee certificate for a particular transaction, or if you are working with loan insurance. Obviously, the big issue is the size of the loan. Another issue we'll see is the cost, but on this slide, as we're talking about the process, when the loans are larger, you have to go through the Department of Interior, the staff, to get approval first before you make the loan in order to get that guarantee certificate. But if it's a smaller loan and if you're working with loan insurance, then there's no prior approval required. So it's an easier program to use. So I mentioned the cost. There's significant difference. The guarantee fee is 2%, whereas the insurance fee is only 1%. And you'll see the catch when we talk about what you have to do in this situation in the event of default. So guarantee fee that the borrower pays and the insurance fee at 1%. Okay, so and the whole idea to have this extra type of guarantee or insurance is to provide that added protection to you as a lender, of course. And that comes into play in the event of default. So if the loan goes bad and you have to, you go into default and you need to make a claim, then what the program requires that you do, it will give you two choices essentially. If you are using the collateral program or the guarantee program, and you have two choices. You can either first liquidate the collateral to minimize the loss, your loss, and then file a claim to Interior. Or if you don't want to go through the process of liquidating any of the collateral, you can just file a claim directly to Interior. But your claim can only be for 90% of the loan. It's a 90% guarantee. So you may experience loss, and so in some cases, if there's a way to liquidate some of the collateral, that's the preferred option. Generally speaking, they say that you get a decision within 90 days, so it shouldn't drag on for too long. And then after the lender is paid, Interior will still continue to pursue collections. That's the policy. Now, I don't know. I've not seen it in practice to see how that really plays out. But I wanted to mention that because you don't want to be in a situation where, because you as a lender working very closely with your client, if the loan is in default and you make the claim to Interior, that the lender thinks, okay, or the borrower says, okay, well, this is over, it didn't work out, and they go on about their way. They need to know that there would still be collections pursued against them, and of course it still has an impact on their credit and their future ability to borrow. Now, the difference here with insured lenders is that you must liquidate collateral first before making a claim. Smaller loans, different kind of collateral, and that's their requirement, that you have to liquidate first. So that makes it tricky because, I mean, no one wants to be put in that situation where you are having to deal with a lease or depending on what type of collateral that's involved with the loan. Okay, so the limits on the claims, as I mentioned, the guarantee or the insurance is for 90% of the loan amount, so it's not like a 184 where it's 100%. And also, if you're a lender and you've got a portfolio of these loans, loan program portfolio, there's a cap of 15% of the entire portfolio that can be made in a claim. So what I'm told that people, in order to minimize their risk further, is in some cases they may decide to their loan that they've bank, and that will be in the state will they then can minimize their risk exposure because they will this cap. But it's 90% of the loan amount. This requirement may be something that you'll want to speak more closely with the staff about how that potentially could impact you as a lender if you plan to become active in the space and to have more on your book, and kind of talk through the benefits of selling them off. Because there are requirements that you do have to, there are certain steps you have to take when you're selling these types of loans. And of course, they're your clients, so you don't want to kind of make a loan to them. You presumably have worked with them for a long time to get to this point to be able to qualify for the loan, and that's not necessarily in the nature of CDFIs to sell these loans off and completely. So why is this worth it to the borrower? What is it that the borrower gets out of this? Well, of course, as we talked about at the beginning, this helps to level the playing field for Native businesses. Whether the business is the typical business that a CDFI works with, a Native-owned business, whether it's a tribal enterprise, whether it's a tribe itself, they can face any of these types of issues. Obviously, collateral issues, no history and operations of the business. They might be just startup. They have no experience with financing. Some lenders have issues with jurisdictional issues. There may be concerns about sovereign immunity. And the nice thing, of course, about CDFI is that you understand these issues, and in your community, you're closer to them. You know when there really is risk involved, and when these things will impact your lending decision. But in some cases, because you are more familiar with it, you know, okay, so this loan we would like to make, but we would feel more comfortable doing it with a guarantee. So that's definitely a benefit to the borrower. And then, of course, it increases their access to affordable business capital. And for many, and Interior, as you've seen, they've been doing this since 1974, $1.4 billion. They have seen that it can be a great starting point for borrowers on their path to prosperity. They say that some tribes, some of the bigger, more successful tribes have started with these types of programs. Like Seminole used in the early days, they used this guarantee program to get them going. So good effort of getting businesses off the ground, including tribally owned businesses. Okay, so what about the lender? I mean, you guys want to know how does this help you in your business plan? Well, as we talked about, it does reduce your risk because of the insurance or the guarantee. It does help provide that extra comfort level to your loan committee where you're comfortable with the situation, but you would feel more comfortable with this extra layer. It enables you to approve a loan that you may not have been able to approve otherwise, or may have been felt like it was just a little bit outside of reach otherwise. It also allows you to offer better terms because you can perhaps offer lower interest rates because you don't have to, or longer terms because you can. The program allows a longer term than say maybe your typical business loan, and it may allow you to go bigger, to lend more because of that extra layer of protection and the reduction in the risk. So those are great things for you as a CDFI. Now, I'm going to share some of the things, talk to the other CDFIs who are participating in this, and then just pause to see if others have questions. But that I heard from Native CDFIs is definitely be familiar with the regs with this program, because there's only 4 that manage these. The more familiar you are with the regulations, the less surprises you'll get. And, obviously being not only familiar with the regulations, I would add being familiar with the staff and kind of what's important to them and developing that relationship, just like you would with any other partner that you're working with. Start small was another recommendation. Don't try to insure every loan you make because, it's not an overly burdensome program, but it is a federal program and it does require some extra steps. And so you don't want to kind of jump into it too quickly. Don't be afraid to negotiate with the staff. I think I mentioned at the outset that some of the definitions and some of the requirements were very broad. And for example, the impact on a tribal economy, if you can make the case that the impact on a tribal economy is very, very strong, you may be able to make the case for funding a business, making a loan to a business that's not actually on the reservation. Now, I don't think that's a common practice at all, but that's just an example of how if you can really document and make the case that you're complying with the overall intent of the program, that you may be able to get a little more flexibility out of it. At the same time, you still need to be diligent with underwriting and documentation. The experience of the CDFIs that have worked on this, they've said that you need to have your T's crossed and your I's dotted and make sure that you're following the right. It's the Department of Interior, so you need to be sure and follow their policies. And with regard to filing a claim, and we've talked about this, make sure you make all attempts to recover. And I think that's great advice because you want to make sure that you've done as much as you can, and if you can't liquidate, you can say in advance, all right, we tried this and this didn't work, and you can go through the steps and be prepared in advance to address and document your attempts in the unlikely event, or at least
Hey, Joanna, I think you might be muted. I'm not hearing you anymore, so I don't know if you want to unmute your phone. I think maybe it turned to mute by accident. Oh, I think her phone dropped again. Sorry about that, folks. We're going to try to get her right back online if you just have patience for a couple of minutes, and apologize for that.
Hi, folks. Joanna's just dialing back in, so if you hold on just a few more moments, she should be right back. Thank you for your patience.
Okay, Stephanie, I'm having bad phone karma. I'm not sure what's going on here, but I hope it has nothing to do with answering questions. Can you hear me now?
Yep, that sounds great. And we did have one question come up.
Okay, great.
It says, it's been my understanding since CDFIs were not insured in the same manner as banks were, just like credit unions and CDFIs, could not participate in the loan guarantee program, but could participate in the loan insurance program. Have the insurance requirements changed for CDFIs?
As far as in deposit insurance, I think that's what the question is about deposit insurance. When I spoke with the gentleman from Interior, he did not distinguish between CDFI is participating in just the insurance program, but if that's something that someone has been told in the past, I would definitely go back to confirm. I mean, he when I spoke with him, he didn't distinguish between either. I think the issue is that most participate in the insurance program because it's for smaller loans. But my understanding is that you could do either, but I don't want to give anyone bad information because I'm just passing along the information that I got from the staff person. So I think, to the best of my knowledge, it's correct. But if someone wants to type in a situation that they've been in to share, that'd be great too. Happy to address that. But again, I think, I mean, let me throw that back out to the audience or to the participants. Are there folks on the line who are interested in doing larger deals and would like to pursue the guarantee? And Stephanie, I don't know if they can raise their hand to just respond to that. Would anyone like to do the guarantee for larger loans looking to do bigger deals? Either type in the box or raise your hand, and Steph can tell me what folks are saying.
So Sheila Herrera raised her hand with Tiwa Lending.
Okay. Hi, Sheila.
And Shireen Harper just said it's not applicable.
Okay. Yeah, I mean, I think it's good to start. Go ahead.
Oh, we had one more response too.
And Audra with White Earth said she's interested.
Okay, great. Yeah, hi, Audra. I definitely think that even starting with the insurance program, and there are definitely differences, and I think that just sitting down and talking with the staff about your institution and the types of borrowers that you're trying to serve. And in fact, I think, in terms of who is appropriate for this type of loan, like, looking at your clients and the types of clients that you're working with, if you have someone who's got issues with collateral, as we talked about earlier, the benefits, in fact, I'm just going to scroll back to that slide real fast to show you can. We talked about here the benefits to the borrower. So if you're working with someone whose collateral is called into question, if they have collateral but it's either land-based and it's a lease, or they're having a hard time kind of putting together enough collateral for the type of loan that they're doing, or they just really don't have that much history, they're a startup business and don't have, or they might be an ongoing business, they might have been around for a long time, they just haven't gotten financing before. Or if it's a tribal enterprise, and the tribal enterprise is a limited waiver of sovereign immunity, and they're having a hard time getting a lender to kind of understand that. Without this type of program, you may be able to kind of step in and serve those types of clients. Okay, so if you have more questions, please keep typing them in, and Steph and Heather will interrupt me. But I did want to let you know that I added the website. I mean, obviously you can Google the name of the program, and this website will pop right up. But I wanted you to see that it's the Interior Office of Energy and Economic Development, I can't say the initials, but the Division of Capital Investment is the division that manages this. And you'll see a number in the handouts that Heather will be sharing with you, some more background and resources for you to take a look at about how they're structured, and kind of the overview and some examples, other examples of the program, the types of loans. So I'm going to move, I just want to touch really briefly on some of the other guarantee programs that are out there, because a lot of times people think, oh, well, I'm not interested in guarantee programs at all because they don't actually provide capital. You have to have the capital to participate in them. Well, of course, the third one on the screen you don't, so we'll talk about that. But the SBA 7A loan program is for smaller small business loans. The USDA business and industry loans. B&I loans, it's another program that may help to serve the same type of audience, type of borrowers, but it's not specifically for Indian country. So the Interior program is more targeted to Native clients, which is why I think it's a good fit for you all. The Intermediary Relending Program is not a new program. Obviously, it's been around for a long time, the IRP program. But once you kind of get into this realm and you kind of acknowledge that you're going to take the extra step to go through the bureaucratic, to jump through the bureaucratic hoops, and you've got staff on board to do the extra work that's necessary to manage these programs for reporting, you might as well look at the IRP loan if you haven't already, because it is a longer-term, lower rate source of capital. And this is a direct loan program which actually allows you to borrow capital and relend. So I wanted to include that here. It's not a guarantee program, but it is a federal program that could be beneficial to your clients and to your business plan, your strategic plan for your CDFI. Now, with everything, there's good and bad. And you know, there are some great things about these programs and some not so great things about these programs. I wanted to share a few and again open it up to folks on the line who have had experience with these or other programs, and kind of help folks think through the pros and the cons, not only of the Interior program generally as a federal program, but also the other programs that Native CDFIs have had more experience with, like SBA or IRP or some of the USDA programs. So it helps. The guarantee obviously can make a riskier but still safe loan more doable. So you can make riskier but still safe loans. It means that you're not going to make bad loans. You're going to make loans and you're going to have that extra little comfort blanket. You may open up the secondary market because the loans may be more conforming. It may mean that you can sell them, and that, you know, of course, in the mortgage industry, that's certainly the case. And with other types of federal programs, it might make it easier to sell to another bank or to participate in another deal. It allows you, by participating in these programs, it's kind of an entree to you as a lender to diversify your portfolio. If you've been wanting to get into business lending, this might be a way to kind of dip your toe into the water. And, you know, of course, if you're expanding and doing different types of lending, then you're serving your borrowers better. You're serving your community better. You're helping to build more capacity within your community and bring more capital to your community, which, of course, is your mission. Now, on the con side, and you know, what's not so great about working with these programs is, of course, the reporting requirements. In some cases, like the criticism that, or the issue that most people have with the SBA 7A loan is that your entire board has to do a background check. And some organizations just on principle say, no, our board doesn't want to do that. We don't think we should have to do background checks, so we're not going to participate in this program. So, you know, there may be some more intrusive types of requirements that you have to go through in order to qualify to participate in the program. And, you know, the reason for all those types of things, of course, is that the federal government says that they're protecting taxpayer money and they don't want to put the taxpayer money at risk. And so there are certain steps that you have to go through. That's their perspective. And along the same lines, the underwriting criteria of some of these guarantee loans may be a little more strict or limiting than what your community needs. The whole reason that CDFIs exist in the first place is to do the types of loans that other lenders can't or don't want to do. And so you, in many cases, I mean, I've talked to one Native CDFI who said, well, I became a 184 lender, but I'm not participating in it because their program isn't really meeting the needs of my borrowers. My borrowers tend to like our portfolio product better, so we just have never done a 184 deal. We just do our product. The other issue that comes up a lot with the guaranteed programs is, well, geez, we might participate in this, but we don't have the capital. We need to get capital first, and then we can do this. And that's certainly a valid issue, and the only thing I would say to address that is that if you're able to do these loans and sell them and then kind of turn over your capital and be able to re-lend and to turn, then that's beneficial to your community because you can lend more. But of course, you have to have the capital to be able to start that in the first place. But I mean, you know, as an advocate, I would make the case that if you're trying to secure a type of capital, even so far as a NACA loan or to borrow capital from someone, to be able to say, okay, part of our plan is to use these guarantees for certain types of loans, and that's going to help strengthen our portfolio and minimize risk, and it's all part of the big plan. No matter who you're working with and, you know, what your goals are in serving your community, as part of your plan, if it's comprehensive and you're addressing all of these types of issues that have come up, then it just makes your case stronger for whoever the entity is that's providing the guarantee or perhaps investing capital into you. Okay, I'd love to hear from others about what you think about these pros and cons, and if you've got your own to share. Or your own experience to say. I mean, some people say, oh, I did one IRP loan, I'll never do it again. And others say, yes, it's a pain in the neck, but I go through it because that capital, I can't get it anywhere else. And I don't like to call on people, but I will if I have to.
Yeah, so feel free to raise your hand, and we can either call on you and unmute you, or feel free to fill in the chat box, and we'll let Joanna know if there are any questions. Or if she calls on you, then we will also look for you to respond.
And while we're waiting, or sorry, go ahead, Heather.
I was just saying we'll just give folks a couple moments. Oh, we have a question already.
What is the turnaround time for processing loan guarantees and loan insurance?
You know, I think it depends on the deal, but it is meant to be a pretty fast process. I mean, I think that they are trying not to delay. From my discussions, they're trying not to delay, and the closing of the loan, and they want to keep it moving forward. So I would imagine that it's 30 to 60 days, and I believe that's kind of what they have said in their materials. And I think that you know, folks would probably like for it to be quicker, but it also depends on the time of year. So at the beginning of the year, there's more capital, and towards the end of the year, the closer you are to the end of the fiscal year, you may have to wait. So like right now, if you're applying, you'll have to wait longer because of the fact that the budget hasn't been approved yet by Congress. So that does slow things down somewhat. So hopefully that answers your question. I know that's not a definitive answer, but I don't think there really is a definitive answer.
Great. Thanks, Joanna. We have one more question over here.
What is the first step to be an approved lender?
I'm sorry, did you say what's the first step to become an approved lender?
Yep, that's correct.
Okay, sorry. The first step is to reach out to your region. So what you would need to do is get the checklist. So they don't have an overview of the whole program, read the regs. But I would, I just put the zones back up here. I would contact the person, the contact for whichever zone you're in, and tell them who you are and what you want to do. And what I'm told by the manager, the acting division chief, David Johnson, is that each of these representatives will walk through the process with you, and they'll share the forms and the checklist that you'll need to go through. As I said earlier, I asked for that, and they said, well, it's not final yet. We're revising these. We don't want to distribute them, but anyone that's interested in pursuing this, please contact us, and the staff will work with you directly. So I would recommend that's your first step, and kind of get more background.
And I had something to add too. So at OFN, we ran into Michael Berryhill. He's the gentleman listed on the Eastern Zone at our networking session, and he was very interested in having folks reach out to him, and he was really nice and open. So he's also another gentleman or contact here that you might want to reach out to, because he was really open to talking to folks from the native CDFIs.
Fantastic. That's great. And I'm also told that from Dave Castillo that the Southwest, the contact in the Southwest is also a great contact as well. I mean, I know you'll want to contact your own person, your own zone, your own region. I'm not used to saying zones, but to kind of establish that relationship. But I definitely think that as you all work together, certainly share ideas. And let's see if you, I know that Audra raised her hand that she was interested, and there was about 40% of the people on the line said that they definitely wanted to do this. So, you know, before we wrap up, if you could raise your hand if you plan to pursue this, if you plan to take a step. And it's funny because that was going to be my question to you all is, what is your next step to pursuing this opportunity? What are you going to do? So if you plan to pursue it, please raise your hand, and I'd love for Steph or Heather to kind of read who that is so that you can see who of your peers are pursuing this, so you can kind of collaborate together.
Yeah, Audra said she's working on the email right now, so that's awesome.
Good.
And we see Cindy Middlestat raised her hand, and Forrest Funmaker raised his hand. So did Sean Winters and Sheila Herrera, and I thought I saw one more up at the top. And Audra did, of course, yep. And then I think we had a comment from Anna.
Anna says, I used to work in this division while at the BIA. The individuals who work at Alaska and Southwest are incredibly knowledgeable in the program.
Thank you, Anna.
Yeah, thanks, Anna. That's great to know. I mean, it sounds like, you know, that this is good stuff all around the country. So definitely engage with them. So, and all of the folks that raise their hand, all rock stars. I'm not surprised to hear that they're interested in pursuing this. And hopefully this kind of gets you a broad enough overview so you know whether or not it's worth pursuing, and that you can take a look at the docs that Heather's going to send you. All of them are available on the website, but I went ahead just to make it easier for you guys I included, there's 4 documents about the program, the interior program itself. One is the regs, one is a brochure of the Division of Capital Investment, and then they have one of them, it's called like policies or something like that. Like, it's an overview that's a very helpful Q&A document. And then the other 2 documents that I shared with you are about other types of loan federal programs. One focuses on housing, and the other is just generally government-wide. You may have seen those documents before. One of them has been around for about 4 years, and the other one was just recently published. You may have sent them, but I think they're so helpful and such a nice matrix of all the different loan programs that I think it's worth sharing again, so that in case someone who hasn't seen them will have access to them. So there are 6 documents. I think 5 are posted here, and I'll let Heather explain how that works. But I'm happy to answer questions either now, or you can feel free to email me later. And I may not know the answer to every question, but certainly can help to track down the answers.
Thanks, Joanna. Yeah, I'm not seeing any questions come in now, so I will wrap it up unless I see any come in, and I'll interrupt myself. But yeah, Joanna was right. So she sent me 6 documents, and we'll send everybody the recording of the webinar, a copy of the PowerPoint, and those 6 documents, so you'll have them too. And I just wanted to say thank you, Joanna, for that wonderful presentation. Part of the reason I actually chose this topic is I didn't know that much about the program, and I was really interested and thought it would be useful for folks. So I think you did a wonderful job, and it was really informative. And I also wanted to thank everyone for participating in this webinar. I hope we provided information that you think will be useful, too, to access more funding opportunities for your organizations. And like always, I want to make sure and point out that a very brief survey should pop up when you close this webinar, and just please fill it out. It helps us track the series and make sure that we always continue to improve. And finally, next month's webinar is going to take place Thursday, December 15th at noon, and we're going to be discussing winning grant proposals with Crystal Langholtz and Debbie Goensmith, and I'll be sending out more information about that soon. So that being said, have a wonderful rest of your day.
Thanks, everyone.
Thanks.